Shankar, I don't know where should we start. So I'm going to keep it open. As anchors, I love to frame questions, but today I'll keep it open for you.
Yeah, I mean, we thought we'd seen it all when 2008 happened. And, it's as a student of the market, I was telling somebody that, in a lot of ways, the adult in me is dying every day, but the child in me is loving every single second of this. Because, this is really an unprecedented move in the markets and an unprecedented situation globally. So, I'm an optimist in the sense that, I see a lot of learnings from this. And, we will come out of this, at least as investment managers, a lot smarter, a lot stronger. And to say that one saw a cut like this coming, obviously nobody could see that. But to say that a significant downward move was imminent, that wasn't difficult. So the reason is the virus. It's a huge reason. But even without the reason, I think globally and in particular in India, we were not looking good at all. And usually markets find a reason to cling on to justify a certain move, whether up or down. And the virus has come at the opportune time. But even prior to that, we have spoken many times that in India, India was in a stealth bear market for 2 years. A handful of stocks was keeping things up. And those things can't last forever. Those things end and they end badly. And that is exactly what has happened.
So, Shankar, if you're feeling like a kid in the candy store, what is the kid looking at buying?
No, so we are pretty systematic. So we have a process. We are seeing things that we like 5 days back are down. Another 10 odd percent today, maybe 15%. And again, I repeat this. There's no way to find a bottom. But on the other hand, I don't think you should be really looking at all points in time to be a buyer. I don't subscribe. We have never subscribed to that basic overall motherhood statement that we hear. Because I remember 2009 March when the markets made a bottom. Despite having been convinced the market bottom was there, I could not bring myself to change my mindset, and I missed the first part of the rally, which was a very strong one when stocks rallied like 40-50% up to June. So I got in June. But 10 years later, did it matter whether I got it in March or did I get it in June? No, it did not. The fact of the matter is I was better off buying in June than I was in March, because I was buying with a big, strong momentum behind me. So this time too, you will see a lot of sharp rallies, and those are typical bear market situations when big, sharp corrections happen, which kind of try and tell us that, look, the bear market is over. I don't think we are there yet. We will see some rallies, and from the bottom, I was expecting the market opened at 10% down. I thought this, today is not going to be another 10% down close date. Might be somewhere 3-4% minus kind of thing. So there are stocks to buy, but to buy it all, definitely not. There is still unfolding drama on this whole virus thing, and I don't think we should just say it's just another virus. It is not just another virus.
Right. So, Shankar, as you're saying that right now, this is, of course, a developing situation. Be smart, but don't be over smart, as you said last time. I want to touch upon one sector that is looking a little bit baffling to us as well, and that is the consumer-centric stocks. You aren't seeing that much of a deceleration in comparison to the rest of the market. What is your, takeaway from some of these names within the consumption space, and how are you looking at the basket as a whole?
No, so consumption space has been the favorite theme for anybody and everybody in the last year, at least. 2019 was their year. And, these stocks typically have been classified as defenses. They don't fall as much as the markets do. They, in general, broad bull markets, they tend to underperform. But like I said, India has not been in a broad bull market. It has been in a pretty narrow bull market centered around precisely these stocks. So in a situation like this, people will go to the equivalent of U.S. Treasuries in India. And what is the equivalent of U.S. Treasuries in India in the stock market? It is the usual FMCG set. So it's not surprising. We've seen this kind of thing play out many, many times. Would I say that they all buys? We have always seen them trade at 60 times earnings over the last 25 years. I don't think that's going to change. But like I said, let's wait out and see the situation develop. And as I said, there's no point in just burning up all your powder at this precise moment. Even 10-20% higher with some positive data points, I think you're much safer.
A follow-up question on consumer is that consumers will see a slowdown because of demand-related challenges, and they are expensive stocks. So if the flow of money has to come back, why would it come in a sector where valuations are stretched and slowdown could knock off 2-3 quarters of earnings?
I agree with you, Nikunj. So, I mean, I'm not saying that it necessarily has to be this set of stocks which did well in 2019, repeat in 2020. And usually we have seen many times, where the market will push you towards a particular trade and then it will change direction, right? So US tech was that similar trade and Indian consumers is that similar trade. It'll keep pushing you till, you succumb. And you then go all in and you buy, and then the market will turn from there. I think it could well be that 2020 does not belong to them because that is the consensus trade. It's an overcrowded trade. Everybody is in it. It could well be that the market has changed. And remember one more thing, that the consumption story is not getting hit just because of the virus. India was already struggling prior to that. We were already, at a 20-year low in terms of GDP growth. This has come at a terrible time overall. Overall, the situation was bad. On top of that, when you have a consumption hit like this, these earnings which people are penciling in of 20% compounding for all these companies till the horizon ends, I think that's a bit of a reach right now.
Shankar, my next follow-up question would be on the definition of a bear market. The definition of a bull market has become a bear market not only in India but globally. Now, when markets become a bear market, they could remain in the bear market for months, years, or even decades. How does one react to that?
Very, very valid point, and which is what I've tweeted also, and I think on our First Global handle we tweeted that and this is a bear market. Let nobody tell you otherwise. And like I said, India was already in a stealth bear market. 2019, by the way, Nikunj, was a blowout year for all asset classes across the world except India. India was the absolute dog, growing like 8-9% in Nifty terms, while even Turkey, in dollar terms, gave you 11-12%. Europe was 25-30%. US was 35%. So India sat out the entire party in 2019. 2018 was obviously a terrible year for India. We know that the whole small cap meltdown happened. So 2 years India has done precisely nothing. Okay. And therefore it was already in a bear market. Now this is morphed into a genuine bear market, and bear markets of this kind don't end in a month. Okay, forget 1987. That was a technical crash because of program trading. So that was an aberration. Otherwise, if you go back and see 97-98 Asian crisis took roughly 2.5 years to wind down. Dot-com crisis started in 2000, ended by 2003. The great financial crisis started in late 2007, at least in the US. In India, started first month of 2008 and ended by March, April of 2009, which was like 15 months later. So and despite all policy measures, so the Fed kept cutting rates in the Asian crisis, in the dot-com crisis, even in the GFC, and yet markets didn't react or didn't respond. So that's I completely agree that to just call a bottom at the moment in the first 2 months of the bear market has started might be a bit of an aggressive stance. And, like I said, if you have money in this market at the bottom of the market, I think you're much better than somebody who's fully invested.
So, Shankar, what could go wrong? I mean, right now what we are debating is, the bulls would say, look, China is getting sorted out, so there is hope. The bears would say that Italy is growing, so we don't know. What do you think will be the circuit breaker moment, and what do you think will be the big green light for financial markets?
Again, anybody who says that China is sorted out is believing China. So, that's the other thing that is a big question mark. It might be getting sorted out optically, whether it is in reality. Because remember, this is an incubation kind of virus. You really don't know whether it's all done. And it's like the factor of infection is like several times, right? So, you still don't know what is the level. And in the US, the numbers are vastly underreported. Everybody knows that. New York City, there is no adequate testing available. I mean, countries, developed countries, are scrambling around to get infrastructure in place to even find out how many people are infected. Seattle, where my relatives work, it's like a lockdown city. So all these things, the effect of these things is not going to just get over in 1 month. the effect of these things will linger on. People will be scared to go to malls. People will be scared to take flight. People will be scared to go to a restaurant and eat. I mean, those things are not just like a 1 month phenomenon. It's not like a terrorist attack that happened. People were in a shock for a month and then life goes back to normal. I mean, think about, yourself. Would you like to go to a crowded place? And for how long? You would not. You'd like to say, no, let me wait this thing out. So you're talking at least 2, 3, 4, 5 months of this fear factor remaining. Assuming things are contained, if things are still spiraling out of control, who knows? So I don't want to classify this as a normal routine overvaluation bear market or a normal routine financial crisis kind of bear market, which happened in 2000 and 2008, which had very clear solutions. Here, you don't even have a vaccine which will be available for 2 years. You see, it's an extraordinary situation. And for the first time, it's not being caused by anything to do with stock markets. It's coming from outside of the stock markets, right? So we don't have a model to deal with a situation like this. None of us have seen anything like this.
Taken, Shankar, and as we've been stressing, this is not a man-made crisis. The variables remain very unknown, and the environment is uncertain, and everyone's very vulnerable at a point like this. But if I were to get a little more micro and talk in particular about the private banks, with the way the situation is unfolding in Yes Bank, it seems pretty evident that the lion's share is going to the private sector banks. I know you're saying don't go all out and buy, but at a time like this, would looking at that place closely, nibbling into that space, private sector banks be a no-brainer?
I don't think any bank is a no-brainer, because that is, I've said this many times, it's an animal that can turn any day for the worse. And no business in this world runs a permanent, daily, even hourly liquidity and solvency risk. No business except banking. So, it's a bank, it's a business you need to be extremely careful. So people have chosen the safety of an HDFC bank, etc., which I think is a sensible stance. Other banks, like we have seen, IndusInd was a storied bank, and then it has, been struggling last, at least couple of years. RBL again, storied bank. Yes Bank itself was a storied bank, and we can see how quickly it unraveled. So there are better places in this market than to go and buy leveraged companies. There is no point in going and buying leveraged businesses right now.
All right, Shankar, really appreciate your time. I know you've been busy with some personal commitments and you've still taken time out to talk to us today. That's very, very reassuring.